Hi, for those of you just joining us, welcome. We will start right at the top of the hour. So we're just waiting for a few more participants to join in and looking very forward to today's discussion. Okay, I think we can get started. Welcome all to our webinar, The Race for Returns, How High Purpose Brands Are Taking the Lead. I am Alexa Yeet, Head of Sustainable Finance at CEO Investor Forum, and I will be moderating today's discussion that will build on our paper, The Return on Purpose Before and During a Crisis. I am joined by my fellow co-authors, Gregory Milano, CEO of Fortuna Advisors, and Brian Tomlinson, Director of Research here at CEO Investor Forum. We are also pleased to be joined by Ryan Barker, CEO and founder of BERA Brand Management, whose corporate purpose framework that we're going to dive into today served as the core data set for our study. Our paper essentially reviews the state of play in the debate on corporate purpose and reveals what sets high purpose brands apart from low purpose ones, with a focus on diving into comparative performance throughout COVID-19. We are also going to discuss how embedding an authentic purpose into your corporate strategy presents a competitive advantage for outperforming your peers on a range of metrics, including financial performance, market valuation, and of course, shareholder value creation. With that, we will pause here for a quick poll question that will help us gauge how many of the companies joining us today have a clearly stated corporate purpose statement. So you should see a poll pop up on your screen. Feel free to answer yes, no, or unsure. We'll give a few seconds for participants to lock in their answers. Okay, great. Let's pull up the results. Awesome. So 70%, the majority of participants do have a clearly stated corporate purpose. And that's going to be great to relate to our conversation today. And before we dive in, just want to note that we encourage everyone to submit questions through the Q&A feature in Zoom. We'll try our best to field them towards the end of the session. And if not, we'll do some direct follow-up afterwards. And with that, I'll pass it to my colleagues, Brian, Gregory, and Ryan, to kick us off with a high-level executive summary of our research's key findings, which will set the context for our conversation. So Brian, you want to kick us off?
Good morning, everyone. Great to be with you today. No better time really to be talking about corporate purpose. Right now, the role of the corporation in society is really under review. And I think the fascinating thing, the context for this paper, is that market participants are really playing a leading role in that. If you look at a couple of data points on that over the last couple of years, you had the Business Roundtable statement on the purpose of the corporation, where over 180 leading CEOs said that they wanted to move towards a more stakeholder value approach in terms of running their businesses, moving away from that sort of classic Friedman paradigm of shareholders first. Institutional investors have also seemed to embrace this emerging kind of stakeholder paradigm. If you see in recent surveys by people like Edelman in their trust barometer, investors increasingly expecting a stakeholder approach to deliver value over the long term, and institutional investors expecting companies to have a clearly stated corporate purpose, and very good to see many of the companies on the line today having that purpose clearly stated. Now, the question I think that again in this background is, what are the implications of this? When you hear CEOs kind of talking about corporate purpose, including BRT signatories, one of the first things you'll hear is that this is what we're already doing, in which case it seems to just be a codification of existing practice. You've also had CEOs say essentially that this is the start of a journey on corporate purpose. Now, I think it's really important, and we get to this in the paper, about being relatively specific about what your purpose is, relating that to your business, passing purpose and other approaches through that lens of materiality, so that we don't have this approach that purpose is just all things to all people. We talk about this in the paper, that the stakeholder approach, a purpose approach, is really about prioritization. It's also about authenticity as well, because purpose, it does involve companies saying often relatively pro-social things. And I think one of the important things that companies are starting to wrestle with is, how do we be pro-social and also be authentic? What is the alignment between who we're saying we are and how we're behaving? And institutional investors are often looking at this quite carefully. So for instance, in the context of climate, you've had a number of quite bold initiatives by companies talking about net zero targets and so on. Essentially embracing and understanding science-based targets, scenario analysis, 1.5 degrees and so on. But then of course, sometimes when you look, you'll see that unfortunately companies are funding often lobbying arrangements and so on, which essentially run counter to those approaches. So really important that there is alignment and authenticity here. And I think one of the things that we also want to get to in this context of a real approach to purpose is that purpose is not necessarily always under all circumstances going to deliver enhanced financial returns. And this is something that we'll get to it's possible to have no clear purpose and arguably be quite a good company. It's also possible to be a bad company and deliver strong financial returns. There are lots of examples of companies that do things that are not pro-social and that make plenty of money. What we're talking about here is that moving away from that paradigm to one that is about sustainability and delivering returns over the long term in a way that reflects your sort of stakeholder approach and the communities in which you operate. So I wanted to, with that sort of beginning, I wanted to identify a couple of the kind of operational process points that we talk about how companies can embed corporate purpose before we get to the data in the paper. So we really talk about the importance of mapping your purpose and your stakeholders. Who are your stakeholders? How does your purpose relate to them? What are the material issues underlying your business? And also, what are the governance arrangements for your purpose? And we'll get into that a little bit more. And also then, how do you make purpose lived from throughout the organization as a whole firm concept, from boards all the way through to brands? And that's an issue of governance, of training, of operational processes and so on, to ensure that purpose is really felt within the business. So in this paper, we wanted to look at a particular dimension of corporate purpose and see its relation to various outputs of financial value. And we were delighted to collaborate with Greg at Fortuna and Ryan at BERA. And so what we did was we took BERA's purpose framework, and I wanted to give Ryan an opportunity to give us a sense of what the purpose attributes are of your framework, and the statistics on which it essentially sits. So Ryan, if you could give us a quick overview there.
Great. So before explaining the purpose piece, it probably makes sense to explain a little bit about BERA. We're a New York-based predictive brand technology company. We currently have the world's largest ongoing perceptions of brands in the marketplace. And since 2003, we've been measuring 4,000 brands, 200 sectors across a panel of 1 million Americans matching census. And it was really to understand three things: why some brands grow, why some get sick, and how do they recover? And it enables brand builders to help optimize their positioning and action levers. 2 years ago, we met up with Jim Stengel, the former CMO of Procter & Gamble. He's the author of Grow and sort of the godfather of purpose-driven marketing. And over 3 decades of work with him and his team, there were about 100 different attributes that they were able to see how successful companies were leveraging purpose and those that failed. We took that battery and conducted research on research across 200 sectors, Brian, or 4,000 brands. And we were able to do a data reduction technique to pull it down to 13 attributes that have on average around 75% of the explanatory power on how brands can leverage purpose to grow short-term sales and long-term profitability. To give you a sense of some of those 13 attributes that go through our econometric cultural algorithm, things like, does your brand have a personal connection? Are you culturally relevant? What is your societal commitment? Are you humanitarian? Do you treat your employees well? Is there clarity? Do you bring innovation to purpose? Do you have a point of view in the marketplace? Is there inclusivity, and do you stand out? Now, those 13 attributes get aggregated together and are weighted to create an overall purpose score. And it's important to note, Brian, that our purpose score of the 200 sectors we measure is percentile ranked from 0 to 100. And we do that because we believe there is a zero-sum game that we're all fighting for share of mind, share of heart, and share of wallet. So that's a little bit about the methodology.
That's terrific. And so to clarify for our audience, we're talking about consumer perceptions of brands and their attributes.
Correct.
That's great. So look, we think that's a really powerful framework, and the BERA has developed a overall sort of purpose ranking and score, which you may be interested to see how your own companies rank on there. So would recommend definitely checking that out. So, and I wanted to turn that over to Greg for you to talk about how we then divided up the universe of companies that BERA analyzed and the type of statistics that we found which related the high purpose performance and in relation to financial performance.
Thank you very much. I'd like to start off by talking about how I first came across BERA and how their brand metrics relate to valuation, and then use that as the platform for talking about the research we did on purpose and valuation, because the sequence of purpose to brand to corporate value is actually really an important sequence. And so we found in the BERA framework, some of their metrics don't just drive financial performance, they drive valuation. In other words, they're indicators of the sustainability of performance in the eyes of investors. So how much value do they accrete to a company in relation to its earnings or what have you? And it's this short-term versus long-term perspective that I think is really important to understand. Brian mentioned before that there are companies that produce strong financial results but don't seem to provide very much social good. Over time, that's less common. I'm not saying it doesn't happen, but it's less common. For short periods of time, people can certainly milk some part of the equation in order to produce short-term financial results, but often that catches up with them. And I think the importance of the BERA brand scores and the BERA purpose scores is it gives us a view on the longevity of what we're doing today and so forth. So as Ryan said, the BERA, with the help of Jim Stengel, identified these purpose scores for various brands. We then looked at companies that had the majority of their business activity in a single brand. We call those monobrand companies. And we were able to study the relationship between the purpose scores and other very important financial and other related metrics. And for example, we found the companies scoring high on purpose on average had 5.9% higher return on capital than the companies that rated low on purpose. So much as many finance officers in companies think that investing in other stakeholders and so forth is an expense that sometimes is hard to quantify the benefits of, when you look at it in aggregate, it seems the companies operating with strong purpose produce higher returns on capital, which is a really important financial metric. And probably more importantly, companies that rate high on purpose trade at higher valuation multiples. And that again indicates the sort of long-term sustainability or longevity of performance in the in the minds of investors. And it makes sense that when a company is doing things that relate well to good outcomes for their employees, for their customers, for the environment, for the communities, that would lead to a more sustainable business model than somebody that is seen to be making money off the back of treating one or more of those constituents unfairly. And lastly, and very importantly, companies that rate high on purpose produce much higher overall total shareholder return, including both the appreciation of share prices and dividends. And it's to the point of almost 20% higher return per year for the monobrand companies that rate high on purpose than the companies that rate poorly on purpose. So it's a very important message to the community, but also to companies, that investments in purpose, when done properly, can not only help many of the stakeholders that receive much more attention since the Business Roundtable proclamation, but actually provide benefits to the shareholders as well.
And Greg, I wanted to build on that and give you an opportunity to talk about the sort of patterns that we saw in those performance figures in the context of COVID. I know many of the corporate issuers on the line will have had let's call it a very interesting 12 months dealing with the impacts of COVID on their business. But we saw some really interesting patterns in that data as COVID related to it. So if you could give us an overview of that.
Sure. So my colleague Riley Waitley led some research where we tracked companies, high purpose versus low purpose companies, and what their share price performance was as we entered COVID. And very interestingly, the gap widened. So the high purpose companies delivered better share price performance before COVID, but that gap actually widened and purpose seemed to matter more once we get into COVID, which seemed to make sense, but it was really comforting, I think, to see that, the sort of voting of everybody betting on their investments in the stock market and so forth actually put more money behind the companies that seem to have a more sustainable business model than the companies that didn't.
Yeah, it's interesting. This seems to play into some of the other sort of market trends that we see where consumers are increasingly willing to pay a premium for products that they associate with sustainability. So there's clearly a movement in consumer preferences towards products which are communicating more than just the product itself. It's speaking to something deeper. And the more brands can do to kind of associate themselves with qualities that people value, the more I think these benefits will be sort of realized. So I think that's a decent overview of the report and the research. So I think we can go into Q&A now and hand back to you, Alexa.
Great, thank you for that. And again, a lot to unpack there. I just wanted to refer back to Jim Stengel. He put it simply: purpose is no longer a choice or a nice to have. And our paper really works to solidify that those who have it will win through delivering superior financial performance and shareholder value. And as it relates to the attributes that we see included in the purpose framework, it seems that ESG is really an expression of your purpose, and you have this conscious consumerism on the rise. And as consumers are looking to align their values with the products that they're buying, to, they're more mindfully allocating their purchase power to these products. We also see that the voice of the customer, if you will, can define the financial trajectory of a company as they seek that shared sense of purpose. So I think that's a really interesting finding as well. And we'll get into that. I know, Ryan, you did a great job at kind of walking us through the BERA Purpose Framework. Again, this is the largest brand equity assessment platform out there. Maybe you can give us a few more examples of how you've seen brands mobilize their purpose for growth and consumer loyalty, with a nod to kind of, again, how consumers are really defining this space.
Yeah, absolutely. So it's interesting, if we think back in the 90s, we had the triple bottom line and social responsibility was a big thing. I want to be clear on why we partnered with Jim Stengel. It's not about just doing good. Of the 13 attributes, purpose could be things even like just having a strong point of view in society. Of course, the social responsibility piece is one of the many ways to build purpose, but that was one of the key elements. Mm-hmm. And what we find is when companies are optimizing their corporate positioning in the marketplace, and we talk about the emotional benefits and the functional and the experiential, purpose is sort of the connective tissue or the true north that allow those all come to life. And I think we might hit on this later, but one of the challenges that we've seen for brands is when the CSR department is left to go focus on purpose, while marketing is focusing on the corporate positioning, and those two are not talking together. And so what we found, especially during COVID, those brands that had a strong purpose were able to weather the storm better than those who didn't. But the critical piece is making sure that it's integrated into your positioning and properly operationalized across the 5 Ps: product, price, promotion, place, and people. One other critical thing to hit, and for everyone, if you don't know what your purpose score is today, and if you haven't begun measurement, feel free to go to brandpurposescores.com. There are 200 sectors to look. But one of the things interesting is when we think about the corporate positioning and creating your purpose, if you have a large portfolio of brands, we have found that a lot of companies feel it's okay just for the master brand to live and breathe and communicate purpose as opposed to the entire portfolio. And a good example of this is Apple and Samsung are 2 incredibly healthy, loved brands that we are measuring in real time. And then you take a sub-brand like iPhone, their equity is just as strong as the parent brand, and their purpose score is just as strong. Now for Samsung, if you take a look at Galaxy, it's a fraction of the equity of the parent brand, and its purpose isn't unified with that. And so what we found is if you can operationalize this across the entire portfolio and it becomes part of your connective tissue, it's a lot easier to take on a big empire and begin to shift for those financial gains.
Great. Two things there. You spoke about getting teams to talk to each other. I think to that point, it's really about that long-term cohesive narrative that you're putting out there. It needs to be reflective across not just your macro brand, but all the different functions that you have internally, and translating that out into the different lines of brands and products you have out there for consumer access. So unsiloing teams internally is a topic we're definitely gonna dive into a little bit more. And with that, I just, the examples of Samsung and Apple, these are 2, tech leaders who have managed to really put forth that cohesive message as part of their long-term sustainability strategy. So I want to turn it over to Brian. How can companies provide examples of how purpose is operationalized? I know you spoke in the recap a little bit about that technique of stakeholder-oriented materiality assessments. So if you could elaborate a little bit more on that, and what are some of the other best practices you've seen on operationalizing purpose?
Yeah, so this is about treating purpose as a whole firm concept, ensuring that it flows all the way from the board all the way through to the brand. Now, in the report, we make 3 specific suggestions about this. One is that the board must engage with corporate purpose. Understand who the stakeholders are, understand the time horizon over which the company is managed. And that's also a way to meet some of the emerging institutional investor expectations around communicating corporate purpose. There are some companies that are just getting started with this concept of a board-issued purpose statement, which essentially ensures that you're sort of pushing purpose down from the board, providing management with cover to pursue the time horizons that are set out in that statement, to remove some of that sort of potential board sort of CEO pressure around short-termism. So that's a really interesting technique that some companies have started to engage with. Now, then at the next level down, it's conducting a stakeholder mapping and materiality assessment, because what corporate purpose can't be is all things to all people. It's who are your material stakeholders, on which stakeholders does your business model rely, who are the key ones into which you need to make investments. That also gives you a sense of what your impact is on the communities in which you interact with. Now, this is also information that investors are increasingly interested in understanding. How rigorous, how coherent is your process for understanding who your stakeholders are? And as a related matter, what's your process for understanding your material ESG issues? Mm-hmm. Now, if you've done that internal mapping, that gives you a kind of fighting chance of then being able to also not only communicate some of those issues internally, but to also be able to communicate those issues to the capital markets. And then this also comes to the issue of how do you mobilize purpose. You know, there are a number of studies which are quite interesting. I'd identified the Serafheim and Gartenberg study, which indicates that, you know, corporate purpose is really about clarity, managerial clarity. You know, it's not about sort of backslapping camaraderie. It's not about feeling like you're good people. It's about, you know, what are we incentivized to do internally? What are our targets? And that means that ultimately middle management have to understand what the corporate purpose is. Corporate purpose has to have an impact on real decisions. And one of the things that we've seen is companies who are really trying to embed their approach to purpose in their training across middle management and identify ways in which corporate purpose meant that you decided one way rather than another, to ensure that it sort of has teeth. And essentially what we're talking about here is kind of mapping and governance, so that you're, as a company, you're talking about your corporate purpose from a stable platform. Now, there's a lot of work to be done here, but once you've done that initial work, that then gives you an opportunity, as I said, to talk to the capital markets about these issues and meeting an emerging sort of expectation, but also to begin to construct, you know, metrics and accountability for people, to sort of potentially link purpose metrics as we're linking ESG metrics to executive pay. And given some of the stats that Greg was talking about the interaction between purpose and performance, you know, it's appropriate that these are potential metrics specific to the business model, you know, which can filter into executive pay.
Yeah, it's interesting. You know, we hear it often compared to a North Star. So the board helps design and implement the purpose from the top down, and middle managers are really seen as those that mobilize it across the business functions. And being anchored by purpose helps shape how companies address their ESG issues. And that speaks to what we covered in the recap a bit of how purpose is really, again, that North Star for how resilient your company is. And throughout COVID, our study kind of proves how companies that were more clear in how they were addressing their COVID impact or their COVID efforts that they were putting forth for communities and their consumers, they turned out to be more financially resilient. So it's just interesting how it all ties back to what is now, you know, a statement such as purpose. On that, I wanted to pass it over to Greg to hear a little bit more about the insights around value creation and valuation that come out of analyzing, again, the impact that COVID-19 and the COVID crisis had on companies who scored high and versus low corporate purpose. We know in our study, we really touch on purpose as a crisis management tool. So if you could elaborate a little bit more on that, that would be helpful.
Sure. I mean, it starts with the same resilience point that we were just discussing. But I think it goes beyond that, and we need to you know, think about what are the obstacles to trying to embrace purpose in an organization. And you know, for my career, the last 30 years, I've been focused on value creation, helping companies create more value, originally in the context of shareholder value, now with a much broader definition of value. But the first rule of trying to maximize value, especially from a sort of internal measurement and other related points of view, is it's almost like in the healthcare, right? In medical practice, the first rule is do no harm, and I think that's the starting point. I think when you look at a lot of financial measures that are used in companies and how they're managed that are very tight, variance to plan on a monthly or quarterly basis, it becomes very hard to do things that maybe cost you a little bit in the short run, but get you someplace very positive 2 or 3 years from now. I mean, just a question I often ask CEOs when I meet them is, you know, do you care more about what your share price is next week or next month, or do you care more about what it is 3 years from now? Would you be willing to do something that maybe at first people aren't so sure if it's going to work out or not, but where you're very confident it will, and where you're sure the benefits will be there a few years from now, but, you know, in the short term, your share price might go down in response to it. And I think that kind of broadening of the thinking, still accountability, but accountability over a longer period of time rather than a short period of time, in itself opens up the mind to thinking about these factors. And to answer the question more specifically, in that context of where we might go over time, investments, if a company increases some of its investments in different stakeholders with an intended benefit over time, but it costs you a little bit in short-term financial results, one of the benefits we have is that the BERA purpose scores relate to valuation multiples. And so because the BERA purpose scores relate so well to valuation multiples, even if the current financial performance ticks down a bit, it's quite possible if they're effective investments that the value of the company will still rise, or at least not suffer in the short term, because these valuation multiples go up. And it's really getting the right balance of financial performance and these purpose scores that drive valuation multiples that I think gives you a better sense of how the finance and investment community should view these things. Again, it's the purpose drives resilience. The resilience is recognized by investors. Investors price the stock a little higher in relation to earnings. And so that feedback mechanism becomes much more real when you can see it in an observable, objective, fact-based purpose scores, which is very helpful. Just one more point on this. I think a lot is said in the sort of strategy literature about creating competitive advantages and how competitive advantages allow you to have stronger economic performance and more resilient economic performance, a competitive advantage period, before competition might threaten your position. And in the context of everything we've discussed so far, there really is no better way to establish differential competitive advantages with all of your different stakeholders, not just your customers, than through operating with a good corporate purpose. As we wrote in the title of the last article we did for Financial Executives International together with CECP, the corporate purpose is really just like personal character. There's a lot more to it than just what happens right now.
And would you say to that point, would you say that the personal character can tie into that reputational risk we see with ESG? How companies address and are known for their values and how they translate that into their products, the way they operate their business, that can lead to a more positive reputation at the end of the day.
Right. And that reputation, going back to the comments about how this mattered during the pandemic, that reputation can help a company through any type of crisis. You can have any kind of a situation that threatens the business. Your customers and the community around the company, the employees and so forth, will stand by the company through that crisis to try to, sort of wait to get to the other side of it when they view the company as operating with good corporate purpose. If a company is seen as, short-term profit at any cost, we don't care what we do to everybody else, and a crisis happens, who's going to stand with you? So the durability, during the resilience during a tough situation, which every company faces from time to time, is much better as well.
Yeah, and then in that sense, oh, go ahead.
I just wanted to comment. So one of the things that we saw during COVID, a lot of companies were beginning to communicate their form of purpose. And one of the big mistakes we saw is a lot of messaging of just empathy. I'm sure all of us received a bunch of junk mail of brands we haven't purchased in 1 year, 2 years, 3 years, saying, we're here for you, we're here for you. And people see right through that. One of the top drivers we saw for folks who were introducing their purpose from a messaging perspective was less about communicating empathy and more competence, demonstrating the competence, the understanding during the crisis, we were there for you from a service standpoint, functionality, innovation, et cetera.
Yeah, and to that point, Brian, maybe you can touch a little bit about this now, but the purpose washing that we saw, to Ryan's point, during COVID-19, empty, empathetic statements, but no action, no operationalization. How did you see that play out, Brian, on your end?
Yeah, I mean, it's a great question, because I think at the core of this, it kind of goes to what are the implications of a stakeholder approach to running your business. And I think, what the answer to that is going to depend on your business, your outlook, your time horizon, your management team, and so on. But you certainly saw at the beginning of the COVID crisis, companies were kind of being identified as taking action that appeared perhaps not aligned with a stakeholder approach, where, for instance, a large company continued with a buyback program relatively deep into the early part of the pandemic, at the same time that they, furloughed their workers or simply cut headcount entirely. Now, that seems like that may be inappropriate for a stakeholder approach, but actually it's a company's job to define what they mean by their stakeholder approach. And of course, different constituencies and different stakeholders will feel differently about that, even within the institutional investor community. So you'll have a short-term analyst who's, looking at short-term balance sheet strength, is very happy that they furloughed their workers. But then you have an institutional asset owner who's a universal owner who actually doesn't want to see broad-based unemployment, because actually, they own the market. They're interested in beta. They want a healthy economy. They're not trying to arbitrage different stocks. So therefore, they want people to remain in their jobs. So I think the implications of what a stakeholder approach are kind of up for debate, and it's up for companies to define what they mean. But certainly as companies get into using more pro-social language, extending their messaging onto more sort of contested social territory, there's always the danger of being accused of double talk, or, let's put it politely, inauthenticity. I used the, the example of the climate commitments earlier. That is a very real issue, where you have a large coalition of investors such as the Climate Action 100 Plus, who are, really lobbying for companies to set, science-based targets to hit net zero as early as they can, but certainly in alignment with the climate accords. And then, you see that some of these companies are still funding third-party organizations generally, and lobbying efforts, and indeed, often, politicians who are working directly to countermand those goals. So I think companies, and this is where the governance point comes in, because, companies need to own this stuff. Are we being coherent? Do we know what our public policy stance is? So for instance, if you're saying something about DEI, are you across the piece supporting organizations and people whose mission is also aligned? And I think just that's a big question, because I think that's work that some companies are not yet set up to do. And that may require consultants to come in and help. That may, require looking at, for instance, the diversity of your board, the diversity of your management team, and so on, particularly on that DEI point. But yeah, there's always going to be a danger of authenticity in this space. But strong governance and operational process, so companies understand their stance, it is going to help, and going to hopefully avoid that article in the New York Times which says, you said this, you did this.
Yeah, absolutely. I think, that would be that's a public relations nightmare, but it occurs all too often. And we have our investor activists, our consumer activists, thanks to stakeholder capitalism, rising, and we're seeing companies being held accountable for not, for following through with their statements. And they also play a critical role, which you touched on, in implementing their statements and their ESG efforts into public policy. And I think now with the Biden administration, as they kind of try to link policy and environmental policy together, we'll see corporates get a larger, a bigger seat at the table, if you will. So in terms of purpose washing, that ties nicely into competitive advantage. No two companies are the same. It's a case-by-case situation. It's not a one-size-fits-all, to your points earlier, Brian. And I think if you just work to answer the question, why do we exist? That innate humans have been answering that question for a long time. It applies to corporates as well. If they can answer that one question in itself, by answering that, you establish yourself a pretty large differentiator in the market. So just wanted to make that point. I know we're getting close to time here, and I think it'd be helpful to spend a little time on the key takeaways and practical recommendations. So I'll kind of open up the floor to everyone to participate in this one, but how can companies reshape their corporate purpose to be more beneficial? And what would you like corporates today on the line to walk away with from today's session? Ryan, do you want to kick us off?
Sure. So from a marketing perspective, your positioning and your purpose are one and the same. And a simple exercise, how do we know if the whole company is actually aligned on our purpose, is can everyone articulate how the emotional, functional, and experiential benefits, how it ladders up to our purpose? And if it can't, then we have to institutionalize change. A quick side component of that is we're dealing with so many companies where product innovation is in the hand of engineers, and they're coming out with features for the sake of features, as opposed to which of those features can actually support my purpose in the marketplace.
Absolutely. It's about being more mindful and making those connections rather than just going out and trying to do everything at once. Great point. Greg?
I have, I guess, two closing points. One is that for companies, when they think about investments in different groups of stakeholders other than shareholders, need to use the same kind of desire for efficiency and productivity that they have for many years in thinking about investments to benefit shareholders. If we have three different possible initiatives that could help our employees, for example, and they all provide the same perceived benefit by the employees, and one is much more efficient to implement, we want to have processes in place that don't just worry about the outcomes, but worry about the outcome in a similar kind of cost-benefit type of way to the way we think about, the way we've thought historically about traditional cost benefits in a profit and loss perspective. And the second point is just to reinforce the idea that from a finance officer's point of view, this is a lot of this comes down to the short-term versus long-term trade-off. It's extremely important that although we want to worry about driving as much performance as we can during a given year for all of our stakeholders, we want to always have the willingness to invest in the future. And in recent years, many companies that have underperformed for shareholders and in many other ways have ended up there because of a lack of willingness to invest in the future. So, this idea of making sure that we invest in the future is an important message for all.
Absolutely, and not seeing it, as you said, as an expense. It's the new research and development, if you will, and it needs to be seen as a long-term investment instead of an expense that you're giving out today. Brian, would you like to add anything?
Yeah, a couple of quick points picking up on Greg's comment about time horizon. This is absolutely critical. Purpose and indeed ESG are often investments that are going to pay off over a middle to long-term time horizon. Some of these are going to be hard to assess on a quarter-by-quarter basis. So there is, an important element of just thinking about the time horizon over which we're assessing the themes and the things that we are investing in. I'd say cross-functional collaboration is absolutely key. See that in the ESG space, see that in purpose more broadly, just to ensure that the companies are, integrating the functions, working groups help, just to ensure that companies understand their approach and nothing's sitting in silos. And again, think of stakeholders and corporate purpose as a prioritization exercise. It's not about being all things to all people. It's what's our purpose, who are our stakeholders, what's the time horizon of which we invest in. And that will help provide management with essentially a roadmap for thinking through, capital allocation and also crisis response. Those companies who have done the work on corporate purpose, appeared to be better able to respond to the moment, frankly, because they've done the work.
Absolutely, and purpose serving as that North Star. Just one comment from my end will be, having that cohesive message from the board implemented across the business functions will be translated clearly out to your investors and other key stakeholders. We do have a quick 2 minutes left. I do want to take two questions from the audience that came through. We have one from Jeffrey Green. Can you say more about the mechanisms through which brand purpose drives valuation? Greg, this might be a great one for you if you can answer it quite quickly.
Yeah, again, it's all about the sustainability. Brands make business activities more durable, more sustainable. They attract higher pricing because people see value in the corporate purpose, and all of that tends to drive valuation higher. And that's, you know, an important objective of corporations.
Excellent. And then one last one. Many large companies have a foundation that manages a CSR portfolio. How do you see the role of traditional CSR evolving in a purpose-driven environment? Any takers for this one? This is a question from Jenny Lewis.
I think the key to this is, again, this point about alignment, ensuring that your activities are aligned, are related to what you do as a business. How is your philanthropy aligned with what you actually do?
I'll add to that we have clients where the CSR group unfortunately gets the low end of the stick in terms of Marcom dollars and investment. The ability to tie the importance of purpose to TSR empowered them to get, one, more dollars, and to ensure they weren't siloed and that they can operationalize their purpose across every line of business. So I think the importance, the role, and the financial responsibility of CSR is going to expand in the near future.
Absolutely, and it ties into sustainable finance, mobilizing capital towards what matters and using purpose to really decide what attributes you want to mobilize capital towards and how you want those attributes to reflect the values of your company. So we'll pause here. We're right at 45. Thank you all for joining. We will be circulating a recording of this webinar to everyone, and we will also be circulating key resources, including that of our paper, The Return on Purpose, Before and During a Crisis. So thank you everyone for joining. And before we all log off, if you could quickly just take this next poll for our NPS score, let us know how we did, helps us improve in the future.
Thanks everyone.
Thank you.